Delighted to have Jeffrey Auxier here with us today. Jeffrey Auxier is president of Auxier Asset Management and founder of the Auxier Focus Fund. Prior to forming Auxier Asset Management in 1998, Mr. Auxier spent 16 years at Smith Barney, formerly Foster Marshall American Express, then at Shearson, where he was on the Portfolio Management Advisory Board and the Chairman's Council, and was Senior Vice President of Investments and Senior Portfolio Management Director. Mr. Auxier graduated with honors from the University of Oregon with a degree in finance and an emphasis on accounting. Thank you for joining us today, Jeff. And so excellent. So let's transition into the questions. So our first question is, could you please detail your investment philosophy?
Yeah, basically our philosophy, we start with the power compounding is the most phenomenal, underappreciated investment concept out there. And so what the two Buffett rules, the first rule is don't lose your capital, and the second rule is never violate the first rule. Well, that since '82, that's been a savior for our clients. So basically we're looking at the power compounding. As you know, if you're down 50%, you got to go up 100%. If you're down 90%, you got to go up 1,000. So it sounds trite, but it's critical, especially when you hit these difficult markets. And so we're just trying to buy. We're business analysts looking to buy businesses that are undervalued, but they have the potential for the double, triple play if we buy things right at low valuations, and then if the fundamentals continue to improve and the company executes. That's what we're looking for, the double, triple play over, the real long term.
Yeah, absolutely. I mean, I think that makes a lot of sense. And does that philosophy lead you to really, let's say, focus on any specific sectors or industries, or exclude any specific sectors or industries?
When I started, the inflation was about the same level as we have now. And the markets were bumping. They were talking about the 1932 lows. So in 1982, the market was, I think, about 888 or 900. And when you're looking at this high inflation, so I went back 50, 100 years, and they said, boy, to endure, what can endure? And so we tend to, having that background and seeing how much people lost going into that, we're very conservative. We want that enduring business, but at the right price back then. So we ended up looking back, what did well in inflation? A lot of high inventory turn necessities, grocery stores, drugstore chains, companies that waste disposal. When inflation's roaring, you want it's the eat or heat, right? I mean, you don't have the choice. So that was kind of ingrained in me from the very beginning, because when you start in, we have back-to-back deep recessions with rates at 20%. So that's kind of been ingrained in. So we're looking for those high return businesses with low capital, mandatory capital spending, and high inventory turns, great management. But the price, we're trying to make great buys and not depend on the market for returns.
Yeah, absolutely. That makes a lot of sense. And maybe discuss a little bit more why you're, let's say, more attracted to the more modern Buffett approach of investing in companies with moats and sort of runways for growth, rather than, let's say, the approach used when he was first starting out, the more Benjamin Graham deep value cigar butt approach.
Yeah, if you look at great businesses over time, you can high return business over time with exceptional management. You look at, we have some Costco that came out before it was public. I think it's under 20 cents, right? So I mean, that stock's never really been cheap the last 20 years, but it would have been a mistake to sell it. Or Monster Beverage, you look at number one performing stock since 2000. I mean, up 70,000+%, never cheap. So there's kind of a balance. If you can find a really good business model, great management team, and those businesses over time. We had some Precision that Buffett bought under, believe it or not, under $3. He paid, I think, $2.34, but great business model, great great management. And so really the superior business over time, we have a company called First Service. They do property maintenance. And, since '05, I met the management team. I think it's gone, from 2 to 140, So we want to buy these companies, but we don't want to ideally pay up. We're usually buying them when they're hopelessly out of favor.
Yeah, absolutely. I think that makes a lot of sense. What's your advice to someone who, let's say, is, they're in deep value, they're really sort of oriented towards deep value, but they're trying to, switch to being more comfortable in investing in moat companies and maybe paying up a little bit more for growth when historically, they've always tried to buy things at a single digit, let's say, free cash flow multiple, and always sort of been attracted to, let's say, these less quality companies and these turnarounds, these types of things?
Well, I think you want to be flexible, because in a high inflation environment, like in the 70s, high inflation will level all companies. The Nifty 50 and 72, 73, the top 50 companies, well, they're trading over 80, and then you have inflation pick up and they drop to under 10 times. So you want to be somewhat flexible to the market. We've had a growth at any price market the last 10 years. But we're transitioning to a higher inflation in this generation. Actually, the last 20 years, a lot of people have never seen higher interest rates or high inflation. So you want to be flexible. You want to buy those businesses, but you realize that when inflation picks up, there's a lot of downside in these growth stocks right now. They're way too popular. So what we try to do is identify the companies ahead of time, and then we wait and wait for the right price. But you really have to have a huge respect for the downside when inflation picks up, because the normal rule is like 20 less the inflation rate. That gives you your market multiple. So if inflation, say, is running 5% for this year on average, let's say, that'd be a 15 multiple. So if you're in a growth stock that's 100 times earnings, well, that PE compression. So you just want to, what we try to do, I've had 120 management teams this last 12 months, and you want to find these good businesses, ideal when they're smaller, and then you really want to buy them right. And but it's been a period where price really hasn't mattered the last 10 years, but going forward, I think that's going to be much more important. People forgot about PEs the last 10 years, right?
Yeah, absolutely. I think that makes a lot of sense as well. And so you spoke about the high inflation environment that we're in right now. Historically, commodities and commodity companies have tended to do quite well in those environments. Oil, metals, those types of things. How interested are you in investing in those sort of industries, and how much exposure do you sort of have to those aspects of the economy?
Yeah, we have some exposure to energy, although again, the last 10 years it's not been pretty easy. What you want to look at is the how each industry can be flooded with supply, right? So when you look, and also inflation, we've found that companies that say necessity products with high inventory turns, small incremental pricing each year, have been great inflation hedges. The commodity side is really tough. I have farms and ranches, and I've had them since the 1980s. I can tell you, undifferentiated commodities are really tough, right? So you want that business. We met with Sherwin-Williams as well. I mean, if you're paying $50 an hour for paint to have your house painted, you're not going to buy lousy paint, right? So Sherwin-Williams has great pricing a little bit. See's Candy, Buffett bought it for what, 28 million, I think, in 72, 73, and he's pulled over $1.5 billion. And See's Candy, same ingredients, same location, nominal capex, but to go from 28 million to pull out $1.5 billion. So those good businesses over time, we have Philip Morris under 2 originally, 2 to 100, and over time. I mean, the commodities are really tough, and they're prone to be the shale industry invested over $1 trillion, and I think the return was negative on that trillion, the past few years. So you have to be really careful. The marijuana industry, we've done a deep dive for the last 4 or 5 years. We needed maybe 10 to 20,000 acres. We planted 2 to 300,000 acres. So commodities are really realize they cycle. We have Mosaic, for instance, but we bought it at the bottom of the cycle down around 20. It was 160 in 08, but now it's got from 20 back to 66. But realizing you want to have the humility to do the homework and price things and know where you are in the cycle, and realize everything cycles. But the problem with commodities in general, undifferentiated commodities, it can be a boom and bust situation.
Yeah, absolutely. And maybe speak a little bit about how you initially became interested in investing, and specifically value investing.
Yeah, it was funny. When I was 10, I had this lawn business with a 16-year-old in some of the nicer areas of Portland. So I got exposed early on to the founders of Georgia Pacific. At the time in the 1960s, it was one of the top 5 performing stocks. And so the CEO, Bob Pamplin, well, he took $100, I think, in 1956 or 58 to 1976, 100 to 3,000. So I was really lucky because I ended up working for him in a number of businesses, and he taught me. He was a value investor, great investor. Taught me the importance of pricing everything daily, keeping your emotions going off the ledger. So I got really in the teens. I was doing ledgers, and then got exposed in '82. Actually, just cold called Warren Buffett on a Saturday. He was nice enough to take a few calls, and so I was kind of hooked and started going to the Berkshire meetings early, and met Lou Simpson, and met a lot of really good value investors around the country. Just spent a week with Lou Simpson. He was running money at Geico, and so it was mostly just and then having a voracious learning. It's funny. I was going to go to Columbia, and Buffett said no. He said, "You're better off." True story. He said, "You're better off to go get a farm, get far away from Wall Street, and start from A and go to Z." And he said, "Just build a database." So that was his advice back in '82. It was a funny story because it was just sitting there calling. Then I went home, and opened the first Forbes 400, and there he was, number 3. So, and then look at how he's endured today, right? So. All of you guys could, if you just study that approach, that rational, business-like, but a voracious learning. You need to be just an incredible research. Like we say, 98% research, 2% moving things around. Everyone's out there trading, but you need to know these companies. Really. So, but that's how I got started. I just started calling. Then we built a business of top CEOs around the country, and I learned from those CEOs as clients.
Yeah, absolutely. I mean, that's really fascinating. Can you detail more of your sort of conversations with Buffett and with Lou Simpson and some of the other key takeaways you had?
The big thing is just a voracious, dedicated research effort. I mean, in original research, not just getting Wall Street research. That's why now, even today, this last year I've had 120 management teams. What the great thing about Zoom is that you can you have one-on-ones, without going all over the country. But no, and just knowing the businesses, going deeper in, because what you want is, you want to compound at high returns over long periods, and not trade your way, but know those businesses, and high return businesses, like Lou is high return invested capital, good, things that will endure, and not fads, or like I remember in '83, the first PC, personal computer bubble, there's over 32 new IPOs in 1983. They're virtually all gone, but we are buying things like Waste Management, Revco, drugstores. A lot of the enduring Merck, a lot of the companies are still around. So one thing you got to make sure the companies, the compound, you got to finish. I mean, Eastman Kodak, number 2 employer in 1980s, they missed the digital, they had the technology, they just didn't adopt it. So you have to just really be aggressive on your research and finding truth, facts, and knowing accounting also is the language of business. Accounting was the big, Bob Pamplin said that, Buffett said that, because otherwise it's too easy to get fleeced if you don't know the language of business.
Yeah, absolutely. And so you spoke also a little about, starting your own fund, and maybe speak a little bit more about, let's say there's a student who their sort of dream and their ambition is to one day start their own fund. What is your advice on, one, knowing when it's the right time to transition from working for others to really starting your own sort of company, and also how to raise that initial capital?
Yeah, so what I did, so I was on the board with Jamie Dimon. We set up the first separate account in the early 90s in the country with Smith Barney. And then my frustration was just all these pools, and I didn't really know for my retirement. So in 99, at the top of the market, I set up this fund, and I just put all my money in there. And I was, I didn't really set it up to market. It was more like I wanted a place where I knew everything about my retirement, And so it's kind of funny. So the stocks in the fund are up over 830% since we started. And then at the same time, I was looking back at the same time we started, the top growth stocks, that was the peak of indexing. AOL and Yahoo together were 300 billion. And this last year, they were sold for around 5 billion. AIG was another one. It was 33 times sales, 4 times sales, 33 times earnings. Today, AIG's 9 times earnings, and 1 time sales. But all those companies, Coke was 42 times earnings. WorldCom went out of business, Lucid. But the point is that I didn't really, I wouldn't set up a fund to get rich. I would just, I set up the fund because I wanted to, I knew we could beat the market. Like I say, our equities are up 850 versus, markets maybe up 4 or something, but it was more like the power of compounding is so phenomenal. And if you have a vehicle, and then, there's the principle and the Asian mentality, the principal mentality. The Asian mentality is I'm going to sell you something, principal mentality, I'm going to have all my money there. So I'm more interested in mastering the principle of investing. So if you're setting up a fund right now, there's just way too many funds, and there's going to be huge washouts, because when markets go down or flat to down, people don't, if they don't know what they own, they sell it. So if you're really interested in mastering investing for the real long haul, then I would do the fund. But there's right now too many people who don't know what they own. Like Buffett says, risk is not knowing what you're in or what you're doing. but that there's a case where here, the fund equities are up 850%. It's double the market. Now we haven't been fully invested, but from 1999 to 2009, that was the worst 10-year period in U.S. market history. That was our best 10-year period versus the market since 1982. So, but everyone's kind of wants to like set up a hedge fund, but you're better off to study and, like I say, and just focus on the compounding, because these funds, when I started, there were a number of internet funds, they doubled and they were out of business within 3 years, So it's really tough to survive. We had 40% declines within 9 years after we started our fund. So it was like, if you told me that, but now, see, I can tell you everything that's in my retirement. I purposely locked my money, all my retirement into the fund, because half the funds out there have no ownership,
Yeah, absolutely. That alignment of interests makes a lot of sense. And maybe speak a little bit more about your idea generation process, and how fundamental a role do screeners play in that process, whether it's quantitative screeners or whether it's keyword screeners.
Yeah, we don't really screen. I just go through like 1,500 companies a year, and I try to meet as many companies as I can. And I've found there's really no formula. I mean, you can't, a lot of times you can screen for low PEs. Well, you could have bought Russian oil stocks. Well, if you don't really know the integrity, rule of law, and that's one thing, we had Enron, I don't remember that, but Enron went off the boards. Well, they bought our local utility. So we caught that and we got everybody out at 80, went to zero. But one thing I would stress is it's not about a low PE or a low price sale. It's about knowing the entire entity. And so we want to know these businesses usually ahead of time, and then we're waiting for a crash but I would just encourage everyone to understand what is a durable business model. A lot of VCs, they have all these transportation models, and I was on the board with Benchmark, and I was on a Series A early a company called eBags, right? So, but so I saw the VC what they do, and these models like WeWork, and I mean, a lot of these, what you have to do as a business analyst is to determine are these models going to endure? I can tell you from having farms and ranches, anything with a transportation model, not interested, because the transportation just kills your returns. So that's what I would say is you want to be focused on what's a great business that can endure the worst. What I did when I first got in the business, I went back to the 1930s. I go like, I want to know what made it through. I went back to 1929 to 1935. What survived? RCA, number one most widely held company, dropped from 102 to 2. So and everyone back then it was innovation. Well, that decade had more innovation than almost any decade. I mean, you had radio, you had automobiles. I mean, 2,000 automobile companies, you had airlines, and it didn't matter, I mean, it's like we've had transportation bubbles going back to the canals, right? So you got to understand what the hype is and what can endure, I mean, virtually all the railroads went bankrupt, before they're finally consolidated, So the idea that you're just gonna buy these concepts and get rich is this, we deregulated telecom in 98, and I mean 96 to 98, I think it was a disaster because deregulation means supply, So you got to find these fortress businesses that can endure through all of that, because it's so easy to get wiped out,
Yeah, absolutely. And speaking along the lines of that idea as well, overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
Well, yeah, it's hard. I mean, you've had a lot of these platform companies that have been unbelievable, especially out of China. But then all of a sudden, again, it gets back to politics and rule of law. I mean, look at what they've done to Alibaba, Baidu. I mean, some of these are great models. So the platforms have been really powerful. Those have been, the alphabets and what have you. But again, it gets back to the politics as well. So you can't really just look at that model. You have to say, well, like Microsoft dropped 50% from 99 through 2009. I mean, it's a great company, but once the government, same with IBM, once a government just starts to clamp down, it's really tough to make money. So, you can have these great, like an Alibaba, look at what happened to that. I mean, it's a great model, but the government just decided to dismantle it, because they had too much power, right? So it gets back again, Itai, to voracious, like first, a lot of humility and a lot of homework to determine, because a lot of these companies like Fannie Mae and Freddie Mac, they were great companies. I mean, Lou Simpson, I think he had 20, 30% on those. But all of a sudden the balance sheet, went to 100 to 1, and they blew up and went out of business, and so that's what you're watching. You're watching if these companies start drinking the Kool-Aid, or CEOs, they can sink these ships really fast. So what you think, like, again, we talked about Kodak or a lot of these companies and IBM in the 80s. I mean, in the Nifty 50, I mean, things like Polaroid, and I mean, it's really hard to endure. And the reason, we don't buy high multiple companies is because over 30 years, very few companies can even grow at 12%, So if you're buying a company at, 50, 60, and if over 30 years, it's really tough. So there's just no easy formula on this, because you can get killed. Yeah, I mean, it's the humility to do the work every day. That's the one thing. Like, I remember Carlos Sun was interviewed, and he said, we don't take risk, we eliminate risk, and the only way you can really do that is through a voracious, research effort every day.
Yeah, absolutely. That makes a lot of sense. We spoke a little bit already about sort of the MBA and your thoughts on that. What are your thoughts on the CFA and how relevant that is in investment management in general, and then also in value investing?
Well, I think that anything that's rigorous is great. CPA may actually be more valuable than a CFA. Just the only reason I say that is accounting is the language of business, right? So the CFA comes in. I mean, you have Wall Street and all the boxes and all that stuff, but what you're really trying to do is figure out, the true worth of the enterprise, and you need to know that accounting. So, but I'm all for the rigorous, CFA. Again, it's more, what I found is just it's being rigorous daily, and that just kind of shows. But if you have the passion to really study these businesses, go through the transcripts and really learn. It's a learning your entire life, because I think George Gilder said, money is not wealth, it's knowledge and cumulative knowledge. And I was always taught, they can take all your money away, but they can't take your knowledge away. So you want to be like at an MBA pace your whole life. That's the way it is. I mean, or CFA pace, and I'm all for MBA, CFA, PhD. I mean, a guy named Howard Schultz, he's a PhD in accounting. He saved us because he wrote a book called Financial Shenanigans. I would highly recommend everyone read it. And it saved us in the 1990s because we went through the accounting on all these companies, the tech, telecom, media, and saved our entire client base. So, but I would encourage everyone to get as much education, because they can't take that away from you. But I would say that you really, it doesn't do you any good if you're buying a bunch of overpriced companies and they drop 80%, because all of the clients you have, they're going to be gone. Clients, if you're dealing with clients, they can't deal with 30 to 40% drawdowns. So you have to realize that there's kind of a balance there that, but I'm so for MBAs, CFAs, and PhDs. I mean, can't hurt
absolutely. Yeah, absolutely. And talk to us more about how your framework for analyzing management.
Management. Well, we want, like I say, we track. I price everything. I priced everything since '82 by hand. That's one of the best pieces of advice I ever got. It was, and because you know it when you write it down, but you want to, you want the management team, like Jim Sinegal. I remember early on, he was sitting on the tarmac with a guy named Fred Paulsell, and he was doing his business plan. And I remember when he presented, he said 2 promises: I'll only mark up 14%, and I'll visit all the stores. But he was one of those that, under promised, over delivered, kind of like Sam Walton. You want that, humility. Capitalism works if the leaders are servants. So you kind of want, the humility to endure over the long period. Like Rose Blumkin, that's a great. I have all her, she's got all those rules about, in fact, we have these T-shirts I just made up for all the those not 996, you've heard out of China, 996 is 9 to 9, 6 days a week, but that's what it takes. It's like the humility it's not about a bunch of money. It's about like mastering the game of investing. It's kind of like Tom Brady, and I mean, he's not in it for the money. He's in it to master the game. You want to be in it to master, and you want to just, if you have the passion, to me, it's like 7 days a week research, and there's no easy formula. There's no, computer model, because like the 1987 crash, I remember that everyone had computer models, and they had, these programs stop trading or stop losses, which they did. They blew right through them and it didn't work. So everyone wants a shortcut, but the thing is, if you have cumulative knowledge and you start at your age, by the time you're my age, I mean, you have not only, I mean, these massive returns over time, but you're more valuable. Bob Hempel went to like mid 90s. I mean, Buffett at 91 or whatever, he's so valuable now because he's been through like so many cycles, right? And that's why, would encourage you is more, it's not about, allocating a bunch of pools. It's about, really digging in daily on, the fundamentals. And that's the only way I've seen you can endure, over a long period.
Yeah, absolutely. And let's maybe talk about a few case studies of your past investments. Maybe talk about one successful investment you made in the past, one mistake of commission, and one mistake of omission.
Yeah, I would say the mistakes were in the early 80s, when I was kind of relying on research, not doing as much research, relying on a research department, and that was probably, you're always going to have a certain percentage of companies that just, don't execute. And we've had a number of those over. But I think the big thing is to protect, and not take huge hits. Fortunately, we've never really, if you study Buffett, you don't drink the Kool-Aid. You're not going to get blown up like we've seen, half the NASDAQ drop 50% the last, 6 months or whatever. But kind of a funny story on Amazon, we had clients that were, they actually did the second round funding, and I was on my way to this barbecue, and so I had to turn around at a family emergency. So I missed it, and then they all invested in Amazon at probably under 25 cents. That was a good one. But over the years, that's the thing. I like to know a number of businesses now. We're hitting more because, like I talked about the first service. I mean, some of these companies go up, 7, 8, 9, 10, like monster up 72,000%. So now in our fund, we'll if I meet them, I'll put small positions in there, like a Domino's, or they may be expensive, but at cost, those. So that's what's happened over my career, going like, wow, I missed. But the flip side is, I talked about all the PCs that went public and the tech telecom media blow-ups, and the thrift crisis, we made, fortune. The main thing is, if you're ready for the next crisis, you can do, like the thrift crisis, we made 8 times our money buying in, when in the early 90s, when the banks got into trouble. The small banks actually went up 8-fold from 91 to 98, But there's a lot of, like I say, you learn to be very humble, and arrogance will just level, and also high grade ethics, and making sure the accounting is clean. But like, fortunately, we just haven't taken any hits that have been material. But also, I'd say, just buying strictly on low PEs, or that can hurt you as well. So it's a long answer, but there have been many. So that's why the older I get, the more research I'm doing, because we don't want to miss out. But the flip side is, to protect that compounding, you have to do the work.
Yeah, absolutely. And going along with that, talk to us about your framework for diversification and position sizing, please.
Yeah, like I say, with the market, so high, we've had much smaller positions go at cost, because if you're back in the late 90s, you have the Janus 20, most concentrated growth, and they just, they got killed, So will cost, like in the early 80s, we were 10, 12 stocks, but we had waste management. It was 9 times earnings growing at 18%, Well, you don't have anything growing with that ratio, right? I mean, in the 80s, we were buying, when inflation was roaring, we were buying stocks 3, 4, 5 times earnings, and so, but then we could concentrate, but now with you're coming off 10 years of the most easy money. In fact, I have a chart here going back to, you can appreciate this, 3000 BC, Itai, and I don't know if you can see this, but if you look at where we are right at we are at, you see that where we are on yeah, there is the history of interest rates, right? So we're right there. This is Paul Volcker raising rates to 20%, which Russia just did, right? So if we're on one of these, you really have to realize that if you're concentrated in these rates, like real estate, if rates go up 1%, that's a 10% hit on real estate, right? So right now, we've found, it just depends who your clientele is. If you're an insurance company like Lou Simpson and Warren Buffett, they don't have to worry about the client, right? Like if you're in a retail business with clients, they can't take 30, 40, 50% drawdowns, right? We can't take, like a Charlie Munger took that Alibaba position and doubled and tripled. We can't, the clients will, they walk, but so it all depends. It's back to flexibility. So at cost though, we found, if and then you can buy some of these, like we did buy some Monster, but not a huge position, but if it goes up, if you look at Monster versus Coke over that period, Coke I think is down. And in fact, here Coke back then, is 42 times earnings. It hasn't gone anywhere, right? So, but it's a work in process. You're always looking. There's kind of a 4% rule. Like if you get over 4%, we're talking about torpedoes of the portfolio. High expectation, high valuations can torpedo a portfolio, right? So you're always aware if you're getting up 5, 6. We have like a 7% holding, 7.5 in United Health. Well, it didn't start there. I mean, we bought it around I think 42, and it's appreciated up to like 500. But so we're worried about those, but generally at cost, because what you're trying to do is survive and compound over the long haul. I mean, you can, everyone wants to make the quick hit, but what we try to do is we want to make 20-fold over 20 years. We're not trying to make 20% and sell and go back, but that's what so it's like I say, it's a work in process on your portfolio. I price a portfolio every day. We're meeting the managements, we're going through the transcripts, and we're looking down every day. It's like, how much can we get hit? We had Nokia years ago. We bought it before it was, believe it or not, before it was a phone company. So it went from 2 to like 50. Well, it was way overpriced, but fortunately we sold it maybe like 4 or 5 times between 40 and 50. And then it went down to like 8. Microsoft bought them and they wrote them off in 9 months. But, especially if you're in a bubble situation, you have to learn to really, like we went to the top 1% in 02 because, we avoided the bubble. I mean, a great piece of advice by, I think it was George Michaelis told me, he says, or no, Bill Ruane, he said, look, if you can avoid bubbles in your career, you will do fine. So that always stuck with me. Like, wow, that's a good. So if you're in a bubble in your portfolio, trim it. Like if there's no cash flow, right? And so if you can be looking great and then you can be down 80%, you know. I mean, look what's happened to all those growth names with no earnings, you know. And that's but I would say it's a day-to-day, you know, you're looking at that portfolio, you're tweaking, but you know, you don't want to sell, you know, like I sold a bunch of Costco way too early, but you know, look at that, you know. So there's no real easy formula. You have to look at all those factors, you know, and just be tenacious.
Yeah, absolutely. And for a concluding question, what were the most influential events of your investing career?
Oh, and events? Oh, I'd have to say, you know, like the 87 crash, you know, the market was like 21, 22, and then it went to 10. And I said, God, if I get through this, I will never overpay as long as I live, right? So you go through that. So then the thrift crisis, I remember Wells went from 245 to 45. You know, Buffett started buying it like it, I think, you know, 150 or whatever, and it just kept going. And then, well, the Mexican peso. These are all, you know, crisis where we did really well buying into those. And then, you know, all the big bubbles, avoiding, you know, the 2000, 2002, and I think 08, getting out of the financials, Fannie Mae, we sold Fannie Mae, Freddie Mac, Washington Mutual, you know, all those we made money, but you learn in the bad, you know, tough times, but those, you know, having the humility to know, I mean, how fast, like 87, I mean, we were at 22 and I mean, it was amazing how fast that, you know, that was a big drop, you know. And so, like I say, you know, those are all, I can remember, like, it's funny, an analyst I was talking to when I first got started, so, you know, if you all had stock symbols on your back, I could remember your names. But, you know, like, and that's the kind of thing, if you track everything daily, in the big events are the crisis, but that's where, you know, like Shelby Davis said, you know, you make your money in bear markets. It just doesn't feel good, right? You know, that's where you really, like J. Paul Getty never bought an oil stock until 1930. You know, arguably the best oil investor, the 4 or 5 best oil families and biggest families in Texas, they didn't start buying oil until oil companies until it was 3 cents a barrel in 1932. So you want to, you know, these events are the ones that where you make it, you know, you make it in the bad times, and those definitely, they don't scar you, but you definitely remember, you know, and that's why the older investors have a lot more humility, because when you're young, you know, it's growth at any price, right? And then you get hammered and you go like, I'll never ever do that again. You know.
Yeah, absolutely. Thank you so much. This is a really tremendous session, and we really appreciate you taking the time out of your busy schedule to speak with
Yeah,
us.
I know you guys are doing. Yeah, I appreciate it. You know, humbled that I could be part of this. You've had a great list of investors that I follow all of them. You know, so
Great. Thank you so much. Have a great day.
you too. See you.